Think Realty Nation, it's your host, Avi Golhar. Welcome to the Think Realty podcast. Excited to be here with you today. We're talking about one of my favorite topics of all time, self-directed IRAs, custodians, and what it means to put your money in a self-directed account and actually use that money in your account to help grow your wealth and defer taxes and follow all the rules, and why is this a good thing, and how the rich use this vehicle to magnify their wealth. So that's what's coming up on the podcast for today. Also, we'll be talking about real estate investing partnerships. And is it necessary? Are they not? And what happens when they go wrong? So grab a crayon, colored pencil, construction paper, whatever you got. Doesn't really matter. Start taking some notes. It's going to be a lot of fun. This podcast is brought to you by Clint Coons of Anderson Business Advisors. He's nationally recognized for providing bulletproof asset protection, tax, and business strategy advice to real estate investors. Go to www.getbulletprooftoday.com and receive Clint's book titled Asset Protection for Real Estate Investors for free while supplies last. I actually have a copy of that book, and I keep it by my nightstand because it has a lot of information. So make sure you go to getbulletprooftoday.com and get a copy of that book. We're speaking with Vice President of NuView IRA, Jason DeBono, and I want to make sure that we cover some really, really important topics about self-directed accounts, because there are certain ways that you can get it right, and there are other ways that you can get it totally wrong, and then the IRS is going to come after you and your family, and they're going to sue you. No, they're not going to do that, but they will penalize you heavily if you don't follow the rules. Okay, this isn't like, let's draw on the gray line in the area. No, none of that. Okay, this is like very black and white. If you don't follow the rules, you'll get you slapped on the wrist. You don't want that to happen. So let's get it started. Jason, welcome to the show, man.
Hey, great to be here.
All right, so give us a little breakdown on NuView IRA, a little bit about you, your background, and I have like a slew of questions for you, so I can't wait to ask.
Sure. Well, I'll keep it somewhat brief. I started in this industry 15 years ago, and when I got into it, it was a very new and unique idea. Fast forward, here we are 15 years later. I run NuView Trust Company and NuView IRA. We're a custodial firm that services nearly $1.5 billion of self-directed assets. So every dollar of which our clients pick and choose the investments, we're simply here to be the custodian. But it's interesting. You hit on the rules and the regs, and the IRS, kind of making sure that you're staying within guidelines, and really, I think what's changed so much over the last 15 years has just been the sheer knowledge and acknowledgement by the IRS that, hey, this is an okay way to invest your money. There's rules, you got to follow them, but we're no longer, operating under a what-if scenario. The IRS has basically said many cases over the years. It says, we don't have a problem with owning unique assets. We just want to make sure you stay an investor. So been a fun 15 years, and my job now is just to help people understand really what exactly a self-directed account is, how it works, and why, if it's the right tool for them, they should be using this to build their wealth.
So I heard somewhere that the IRS was cracking down on like IRAs and people that were holding IRAs and all this stuff. How much of that was true? I think there was some article last year, maybe early mid last year. Is there ever going to be a threat of the self-directed account going away?
I don't think anybody can answer that with 100% certainty, just because we don't know. Who knows what an administration in the White House could do in the future. But there's absolutely nothing on the table today about IRAs going away. I think what happens in a lot of cases is you have congressional leaders that get attracted to IRAs. There's lots of money in them, but there is no real alternative solution to letting people save. As far as self-directed accounts go, we've seen time and time again the leniency and the clear guidelines by the IRS only further support the idea that buying real estate and other investments is perfectly permissible. And like I said, 15 years ago, we had one or two cases that we looked at and relied on, and now there's hundreds of cases where they've challenged different deals that clients have done, and none of which, other than the client misbehaving, have caused them to view self-directed IRAs in a different light. Bad actors are going to be bad actors, and when you have tax-deferred or tax-free accounts like IRAs, naturally some bad actors are going to try to take advantage of that, and that's what the IRS is looking for.
Totally makes sense, and I appreciate your insight on that. So why have self-directed IRAs become so popular?
I can only tell you a little bit of what I see. I think it really is somewhat of the perfect storm. I think the first thing is we're in a digital age. 15 years ago, we weren't having this video conversation, and we weren't able to really educate the masses. It was a lot of airplane time, and really only people that were willing to get into a room were getting this type of information. So I think the first piece is just the sheer digital and information age that we live in. That's been a major help. I think the second thing is real estate, even though in 2007 and 8 in the Great Recession, it had its challenges. If you still look at the overall performance over the long term, people have realized that real estate is a great asset class, and provides a lot of benefits, including leverage as well as some tax benefits. So you're seeing people enter into that space. And I think the third thing is people simply don't understand the stock market. And, it's not for me. I'm not saying it's not for other people, but, I look at the market every day, and I keep a close eye on it just because we're so tied to it in terms of our business. But I can't make sense out of it. I have no idea why a company with zero profits is going through the roof, and companies that seem to be very profitable are tanking.
Right.
It's impossible to understand. I have a simple rule in philosophy and investing. If I make money, how do I repeat it? If I lose money, how do I stop doing it?
Right.
And if I'm willing to make any investment that if either of those two things happens, I get the answer to my question. I've bought stocks, they've gone up, and I couldn't replicate it. I've bought stocks and I've lost money, and I couldn't prevent myself from doing it again. There's no lessons to be learned.
That's right.
And I think the combination or tsunami of all of those things together is kind of how we got to where we are today.
I'm with you on that. I mean, you take a look at Uber or WeWork,
right?
Or very recently Tesla nearing the $1,000 mark per share. I don't know how any of that works. And even the T-Mobile Sprint merger, right? Great. I'm probably going to double up on stock on that. But I can't duplicate that, and I'm not looking at the 8Ks and the financial reports and the quarterly reporting, right? I'm just getting a tip from my neighbor that's saying, hey, you should buy this stock, but that's the only due diligence.
Exactly right.
So that doesn't help me. That doesn't make any sense. And so I love what you said. I cannot duplicate that, but I can in the real estate world, which I think is a much better. It's a much better exercise and thesis for using self-directed IRAs. So let's talk about the economy for a second. With what's going on in the economy, regardless of the election and whatever, how does the economy impact this self-directed world? Does it or does it not?
It's a very interesting question. And in 15 years, I started in the last year and a half of what would be a epic run in all markets, both stock and real estate market. I was here through the downturn and the Great Recession, as it's since been called, of where every kind of asset class, stock, bond, mutual fund, real estate, took a 50% or more haircut. And then I've been here over the last 7 of 8 years of what's being considered recovery and extended recovery. And what's interesting about the economy is it's really hard from a psychology standpoint. On one hand, when the stock market is booming, people, even though they're weary of its long-term success and they're very weary of the ability for it to keep going, it's like sitting down at the blackjack table and the cards keep falling and the chips get taller. It's hard to know when's the right time to pick them up and walk away.
That's right.
And so, when the economy is like this, it causes a lot of people to question their investments, to wonder where they can go. But what causes a lot of people to move into real estate is, even in a market that declines, if you were to enter the real estate market today and buy a $200,000 rental house, and tomorrow it takes a 20% drop, what most people are realizing is, if I do that in the stock market, I've lost 20% of value. I got no dividend, no income. But if I make that same investment in the real estate market, I still have a renter in there that's still paying me rent. And as we saw through the last downturn in real estate, rents didn't go down, rents went up. So while my paper loss was, on paper I had a loss, I couldn't liquidate this house that was worth less. I was generating return year over year, positive cash flow in return. Nobody can say that about the downturn in the stock market. They just had to wait long enough to ride the wave up.
That's a really good point. I mean, and you take a look at even real estate, the asset class of real estate itself, if you just held on to that, right? If all that you did was hold on to your real estate portfolio through the downturn, you would have been fine. You'd have been totally fine right now. And in fact, you would have been laughing right now, And I feel like a self-directed environment gives one the ability to be smarter about gains for the long term, right? Especially if you have a self-directed Roth IRA. Man, I mean, that is super powerful. Talk to me about that a little bit, because regardless of what's going on in the economy, yes, there are legislative changes. There are certain things that will affect sometimes the way that you invest, depending on your city, state, location, whatever. But at the end of the day, if you're making smart decisions and you're not violating your rules, you're not getting you're not playing an emotional game, you're playing a logical one, especially with the investing side, and you throw it into a self-directed Roth IRA, what happens?
Oh man, that's the icing on the cake. When we talk about IRAs in real estate, just forgetting about Roth versus traditional, they're already earmarked for the long term. And you're absolutely right. You're laughing your way through a downturn because good properties that are generating income, I don't have to sell in my IRA. If I leverage up, personally, I may not be able to carry all of that in a downturn. So IRAs represent that huge opportunity. But you bring something up that's interesting. So many people step over the fact, traditional Roth, what type of account. So one of the things that I like to share with people is really what we do is two parts. The first part is the vehicle, right? That's the type of account you choose to use. And so many people step over that. And all they want to do is get the keys and figure out where they can drive. And we try to take people back, and I'll just share a quick numeric reference that will help illustrate the power of tax advantage growth versus taxable growth. So if you're an investor and you've got money to invest and you've got to decide if you want to buy this, performing asset with your IRA or with your personal money, I want to challenge you to think about these numbers.
Okay.
If you take $1 and you double it for 20 years, right? Every year for 20 years. So $1 becomes 2, 2 becomes 4, 4 becomes 8. And you pay a 25% tax every year, right? Which is not an absurdly high tax rate. And at the end of 20 years, $1 becomes $78,000. Now, at face value, many people would say, well, that's fantastic. I turned $1 into $78,000 over 20 years. So remember, you bought an investment that doubled every year. The same investor can take the same dollar to start with and buy the same investment. But if they do it in a tax-deferred or tax-free account, like a traditional or Roth IRA, and they don't pay that 25% on an annual basis, they get to reinvest the full amount, they have just over $1 million.
Bingo.
So I ask people, forget about what you do with the money, right? Forget about how you drive the car, because the investment side is something you got to come up with no matter what money you use. Yeah. What type of person do you want to be? The investor when it's all said and done that has $1 million, or the one that has $78,000?
That's right.
And if you did that in a Roth, you'd have paid tax on $1 and had $1 million tax free. There's no better scenario. So not only did I make 12 times more money, it's completely tax free.
That's right.
And I'm the same investor.
I mean, I don't understand, and this is where I feel NuView separates itself from the rest of the crowd, right? From the rest of the pack, because of the education that you guys provide, both on the institutional side and then, of course, the retail end. And that's really important because there are a lot of retail investors, just small investors, that don't understand the power of what you just said, and they need to.
Yep.
Long-term investing in a tax-advantaged account yields long-term wealth if done correctly and you follow the rules. Right?
That's exactly right.
That's it. That is it. Right? You go to NuView. What's the website? NuViewIRA.com. Right?
NuView IRA or NuViewTrust.com. We're either one will get you to the same place.
Exactly. Get in touch, right? Start an account, understand. And so here's the big thing, right? You have to understand how a self-directed IRA works. You can't just throw in money willy-nilly and like not know. So there are two components. One, you have to know how a self-directed IRA works and what kind of account you want to open. And number two, you need to understand the investment vehicle that you're going to put your money into and how to appropriately title that, because it's not going to be in your name. It's in the name of the trust. So that's the other piece of the entire puzzle you have to make sure you get right. And once that money is in that investment, tracking it, caring for it, it's the exact same thing. And what Jason's talking about is having a zero tax environment, opening a self-directed Roth IRA, because you're paying the taxes today. So you're not going to pay the taxes 60 years from now, 50 years from now, 30 years from now. And if you're 20 and you're listening to this, you have the best advantage because you are super young. So $5,500 a year. Jason, what's the contribution limit now for a...
$6,500.
$6,500. Look, I don't even know. I think I invested the wrong amount. Like, it just auto-drafted $5,500. So I need to go jump in the lake. But if you're 20-somethings, instead of buying Jordans or buying that new car or the Beamer or some toy, you don't need any of that. Take $6,500 every single year, divide it by 12, put that money in a self-directed IRA account, make it a Roth, pay the taxes on it now, and then push it forward. And you can even do this, for parents, this is a great opportunity too, right? Like, this is an opportunity to give your kids, you can pay your kids, they don't have to pay taxes on it, you get the write-off, and your kids can create a self-directed Roth IRA for themselves, and they can deposit this tax-free. That's great.
Yeah.
So
yeah,
anyway,
you hit it on the head. Get started now. The benefits are too great, and this is really it's not a tax loophole. It's not even some unique code that only the wealthy's super smart, super well-versed accountants understand. Yeah. This is everyday available stuff that people can go take advantage of. And our job is to get out there. We want to, one, educate people. We want them to understand how it works and what they can do. And then two, we want to empower them to go do it, because education without action is just education. That's right. And speaking of education, Brian Martinez from NuView Trust will be joining us at the Think Realty Conference and Expo in Baltimore. That's from March 21st to the 22nd. And he'll be speaking about IRAs and how you can leverage your IRA to go do some amazing things. And again, that's the Think Realty Baltimore Conference from March 21st to the 22nd. You want to get your tickets and meet NuView and build that relationship. That is the time to do it. So you want to get there, go to thinkrealty.com/Baltimore to get your tickets. So Jason, one last gold nugget that you can offer our listeners and our audience with regards to an IRA. The sooner that you start, the more money that you'll end up with. As profound as that sounds, it's a fact. Future value of money is based on, how much money you put in and how long you have coupled with the return. And so many people try to choose return over time. And I'm a firm believer that I'll take time over return any day of the week. And that's the way that you win this game in the long term. And I'd encourage everybody out there, no matter how old you are, you'll never have as much time to generate returns on that money and never have as much time to grow that money in a tax-free manner as you do today. Wait till tomorrow, you lost another day. Absolutely love it. Jason, thank you so much for your time and sharing some insights. I'm looking forward to seeing NuView in Baltimore. This should be a lot of fun. And for our viewers or listeners that want to get in touch, go to NuViewIRA.com or NuViewTrust.com. That's NuView.IRA.com. And they'll be more than happy to help you out and just kind of learn what the real difference is between that traditional IRA and the Roth IRA. And I guarantee you'll be a more empowered investor as a result. Jason, thank you so much for your time. I appreciate it. Thank you so much for having me. Look forward to seeing everybody in Baltimore. You got it. That's March 21st to the 22nd. Make sure you get your tickets. Go to thinkrealty.com/Baltimore. This segment is brought to you by Real Property Management, which is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. Learn more at realpropertymgt.com or call 888-806-7088. So here's the deal. There was an article on Forbes that
It talked about partnerships. When it comes to real estate investing, do partnerships matter? And can they be a train wreck? So here's my opinion on this. The article talks about both sides of the coin. My thought process is you want to get away from building a job for yourself in the real estate space. You want to build a business. In order to do that, you can do one of two things. You can go hire a bunch of partners, or JV, joint venture with a bunch of partners, and one's a CEO, CFO, and COO, or you have a counterpart and you start building downwards and start building a really good team of people. Now, the only time partnerships go bad is lack of communication, lack of trust, and just really lack of market expertise. So if you're both new, as an example, if you're both new, then it's probably not going to serve your mutual best interest if you partner up on a deal without the help of somebody that has more experience than you do. So an example to avoid that would be partner with somebody that has 10 or 15 years more experience, but you're going to have to give up a little more. Once you start to see a little success under you, something to maybe consider doing is hiring employees to do the job, to do the admin stuff, to do the regular stuff that you don't need to do because your focus needs to be on the future vision, your focus needs to be on forward-moving things. So, do I think it's a train wreck? No. Can you leverage them properly? Yes. But if you don't, the financial consequence of it, you're not going to be happy with. Keep that in mind as you start to develop partnerships, and be very well aware of whom you're partnering with as well. That's the tip of the day for you guys and gals out there, part of Think Realty Nation. You want to get in touch, go to thinkrealty.com. You can find me anywhere online at Avi Golhar. Instagram and LinkedIn are my two favorite platforms right now, so certainly reach out to me there. And I will see you in Baltimore. Again, you want to get those tickets, go to thinkrealty.com/Baltimore. Purchase those tickets March 21st, 22nd. I'm going to be there. All my friends are going to be there. It's going to be a great party, great time, and most importantly, a fantastic educational learning experience for everyone. I can't wait. I'm going to be the guy sitting in the front row taking a lot of notes. I'm looking forward to seeing you there. This podcast was brought to you by Clint Coons of Anderson Business Advisors, nationally recognized for providing bulletproof asset protection, tax, and business strategy advice to real estate investors. You can go to getbulletprooftoday.com and receive his book titled Asset Protection for Real Estate Investors for free while supplies last. Think Realty Nation, that's a wrap. Until next time, happy investing.